It's time to give you updates from the world of business. Welcome to Business Incorporated, and this time is coming to you from Nigeria's Federal Capital Territory, Abuja. Here's what we have for you on the program today. Inflation falls to its lowest level in over a year and a half. And relief is coming the way of Somalia as international lenders agree to cancel $4.5 billion debts. And we look at financial innovation and access as it improves in Nigeria by 64% in 3 years. You're welcome to the program. Here's what we have for you, the details of it. We're beginning as usual with the market. Looking at the market today, the NGX is continuing that bull run that it started yesterday. It hit 72,000 index point, has sustained it at intraday, 72,471. That's up 0.24% at intraday. We do hope it stays there. It will be a nice way to close the week. In South Africa, it's also positive 3.10% at 74,893.88. EJX 30 of Egypt is also positive 24,901 after it went up 0.52%. And of course, we have Kenya, but Kenya's closed from yesterday at 193.30, and it's on the flip side, 0.60%. We have to interrogate what's happening in Kenya market, and not a lot of positive moves we've seen there in recent times. We move over to the Middle East now and see what's going on there. We see that Abu Dhabi is at 9,460.02 after it gained 0.27% at intraday. We have Dubai also positive more than 1%, 1.06% to be precise, 3,980.96. And still within that region, we see Saudi Arabia is up 1.22%, a good one for the markets in the Middle East this afternoon. Perhaps COP28 has left a good mark on there right there. 11,540.13, that's Saudi Arabia, and Qatar is also up almost 1%, 0.93%, a good market at 9,927.72. Now let's move over to Berlin and see what's happening in Germany, that the country's three-party coalition government has come to an agreement over the country's 2024 budget. Budgets everywhere, even here in Nigeria. It marks at the end of weeks of long crisis that had plagued Berlin. Well, we have Lars joining us now to give us more details on this and a whole lot more. Hi, Lars. Good afternoon. Well, what went wrong with the original budget that the government submitted?
Yeah, thanks for having me, Inim. It is a bit complicated. The German government thought they were very clever earlier this year when they figured out that they can roll over 60 billion euros worth of unspent debt that had been greenlighted to combat the coronavirus pandemic and use it as part of its climate and transition fund. That is a fund meant to help companies transform their business towards using green energy, reduce their CO2 footprint, or be more climate friendly in other ways. But a German constitutional court said that was not the case. You can't roll that money over because it was planned for a very specific purpose, which in turn was tied to an actual emergency, the pandemic, of course. And outside of an emergency, the German government is not allowed to take on as much new debt as they like. Actually, the so-called debt brake, which is enshrined in the constitution, allows for new debt only up to 0.35% of the country's gross domestic product. Many agree that the debt brake is a good concept, and Germany does see itself as the European defender of solid finances, even though, of course, that makes governing the country and writing a budget a bit harder sometimes.
And did the government come up with?
Well, first of all, they basically put the debt brake back in place, meaning they're not going into more debt. That leaves two ways now to balance a budget: new taxes to bring in more money, or spending cuts. Now, those are the biggest part of what the coalition decided on. They took money out of that climate and transformation fund. It's been reduced by 12 billion euros in 2024 and by 45 billion euros in the financial planning for the next couple of years. But this doesn't seem too bad, and even the Green Party is on board with it. And that's because the fund still has a total volume of 160 billion euros. There's also cuts to the transport and construction ministries, as well as to subsidies for the solar industry. As for new taxes, there will be one on some plastic products, and some environmentally problematic subsidies will be cut, including for farm diesel and for kerosene.
And I wonder how all of this is affecting investor sentiment.
Well, the Fed has spoken, finally, I should say, because markets had been waiting on news from Washington. While the central bank there did not change the interest rate as had been expected, it said it will likely do 3 rate cuts next year. And while that's one less than most analysts had penciled in, that was enough for the market to rally. The Dow marking a new record high, and that news also boosted Asian markets this morning. As for Europe, things are looking up here too. Next up now, any news around the Christmas shopping season would be welcome, because those kind of numbers give investors a closer look at how the consumer is holding up.
All right, Lars, thank you so much for that. I will hope to get a final one from you tomorrow. Now let's go to other markets. Now we move to the United States, where the U.S. stock futures climbed on Thursday after the Federal Reserve pointed to multiple rate cuts in 2024, and the Dow Jones Industrial Average closed at an all-time high. Futures tied to the 30 stock Dow added 102 points, that's about 0.3%. S&P 500 features, as well as the Nasdaq 100 features, gained 0.3% and 0.4% respectively. Features got a boost after the 10-year Treasury note yield dropped below 4% for the first time since August. The benchmark rate was last at 3.95%. The Dow on Wednesday jumped more than 1% to reach a record high above 37,000 after the Federal Open Market Committee indicated it may cut rates 3 times next year. The central bank's commentary is believed to be a tip of the cap of the fact that they're on a path to soft landing, and maybe they will be able to ease policy more than the markets expect next year. Still staying with the markets now in Asia, Pacific equity markets ended mostly mixed on Thursday, with investors digesting the U.S. Federal Reserve move to end its interest rate hiking cycle and signal cuts for the next year. Optimism earlier in the session spilled over from Wall Street, which rallied as the Fed held its rate at 5.25% to 5.5% for a third straight time, and laid out the timeline for at least 3/4 percentage point cut in 2024 and beyond. Forecasts for the core personal consumption expenditures price index, the Fed's favored inflation gauge, have also been pared back by the Fed to 2.4% in 2024 and 2.2% in 2025. That's down from 2.6% and 2.3% for both years. Still in the market now, but commodities now. Of course, the U.S. stock futures with the U.S. decision is still affecting what's going on in the global oil space. And we told you that earlier this morning as we saw both Brent and WTI are gaining some percentage this morning in early trade. Let's go to the metals market now. Gold prices extended their climb to a 1-week high on Thursday after the U.S. Federal Reserve flagged an end to its tightening cycle and signaled lower borrowing costs in 2024, sending the dollar and treasury yields tumbling. Spot gold was up 0.3% to $2,032 per ounce, and after rising 2.4% on Wednesday, U.S. gold futures jumped 2.5% to $2,046.80. The first dovish pivots stock a rocket under gold prices, which used 1,980 support as a springboard to break its $2,000 per ounce glass ceiling. The Fed kept its interest rates steady for the third meeting in a row, as was widely expected. Now let's come to Nigeria. Now, a whole lot is happening right here. As part of efforts to promote trade in Nigeria, the Vice President of the World Trade Center, Abuja, Mr. Ahmed Karim, is advocating the need for effective collaboration and networking in order to create more business opportunities. Speaking in Abuja at the center at the end of the year business and networking cocktail, Mr. Karim urged business promoters to explore new opportunities through networking that will ensure diversification of services.
Since the inception of our operations here at the World Trade Center Abuja, we've been the subject of speculation. Tonight, we break the silence. We open our doors, not just to celebrate the triumphs of the past, but to invite you into the beating heart of our global community. Welcome to a world where the 22nd floor is not just a vantage point, it is a launch pad for your aspirations. The end of the year business and networking cocktail is an ode to connections, a celebration of bridges. We build the relationships that define our journey tonight. Our theme, Urban Elegance, is more than just a phrase. It is a reflection of the sophistication, diversity, and dynamism that defines the Abuja business community. Our strategic trust tonight is not just about numbers and statistics. It's about creating an experience, a tapestry of moments that will linger in our memory.
And it's cherry news for Nigeria's drive in boosting financial inclusion, as reports by Enhancing Financial Innovation and Access, (AFINA), shows that the number has grown significantly by 64% in the last 3 years. The report, however, shows that with formal financial inclusion levels at only 64%, that's up from 56% in 2020, there remains significant work to be done to achieve the ambition of the central bank, which is 95% formal inclusion in the long term. The general manager of AFINA, Oluwatobi Eromosele, who made this known while presenting the results of the survey in Lagos, attributed the growth, particularly in 2023, to a rise in the banked population in the country, as well as major gains recorded in non-bank formal adoption.
Recently, in preparation for the 2023 census, the National Population Commission has come up with new data. So they've gone across the country and they've come up with a sample that then shows us that Nigeria is now more urban than it was in 2006. Okay? Now, financial inclusion is an indicator which we always know is urban bias. So in other words, as the population become increasingly urban, financial inclusion is likely to increase. So we're reporting 68% financial inclusion, and where we had reported 51% formal inclusion, we are reporting 56% formal inclusion in 2020. Okay, so that is the adjustment that we have done. But again, overall, we see not just an increase in 2020. So in other words, even when you account for the urban changes, we still see an increase from 2020 to 2023. That is not accounted for just by the population, because we've already accommodated the increase, the changes in population in 2020. But still, with the 2020 numbers, we see an 8% jump in formal inclusion from 56% to 64% now in 2023.
And from the calculation of the Africa Development Bank Group, Africa loses about $90 billion annually to illicit financial flow in the public sector. Funds that could have been channeled to the development of infrastructure and welfare of Nigerians. Curbing these leakages through public sector office holders is the initiative of AFDB's Public Finance Management Academy. The bank is concluding an 18-month hybrid course for 52 government officials from 26 African countries. One of the facilitators, the Executive Secretary and the Chief Executive Officer of Nigeria Extractive Industries Transparency Initiative, Dr. Oji Ogbonnaya Oji, believes that the training will revive values and consciousness in the participants.
It's nothing like self-discipline. Self-discipline, self-contentment, espousing the values for which we Africans are known. Those values are there, but we don't have to jettison them. It's because we have overlooked them, because we have jettisoned them. That's why we are where we are. The big elephant in the room is as a result of our failure to understand and abide by ethical conduct. So when you go to societies where sanctions and intensities have put deterrence on what people can do, you enjoy those societies. The roads are working, values are promoting hard work. But why would you continue with a society where you see people with wealth without work and you worship them? I'm immensely impressed with the intervention of the African Development Bank Group, because gathering all key anti-corruption agencies and institutions and champions across Africa, there is hardly any country that is not represented here, and holding it in Nigeria is very instructive. And I'm happy that the experiences we have shared in the room, whether it's in Nigeria, whether it's in Comoros, whether it's in Seychelles, whether it's in Ghana, whether it's in Cote d'Ivoire, are almost the same. Everyone is acknowledging the fact that corruption is a big elephant in the room in African continent that requires collective action, collaboration, sharing of information and data to deal with.
Welcome back to Watching Business Incorporated right here on Channels Television. It's Commodities time and we're discussing chocolate, the joy to a lot of children and some adults. We have joining us for this conversation Miriam Ode. She joins virtually from Victoria Island. Hi, Miriam, good afternoon. So we're talking chocolate this time around, but not in very good light, because it's the price in Nigeria spiked about 150%. I can't say we're surprised, because even though we do produce cocoa, we do not, turn it to chocolate before we can export.
Yes, exactly. And like you said, we don't usually produce chocolates, so we mostly import this commodity, and that means that we are susceptible to increases in the global price of the commodity. And even globally, we've seen that in Europe and in the US, as in America, we have seen that chocolate prices have increased by 13% and 20% respectively. And this is due to rising input costs in this region, because the global price of sugar and cocoa have increased in the past 1 year to about, cocoa has increased by 63% and is currently trading at a 46-year high. Meanwhile, sugar has also increased by 8.9%. So these two factors, that's the increase in the price of cocoa and that of sugar, is weighing on the price or placing additional price pressure on chocolates globally. And since Nigeria imports this commodity, we're seeing that it's also affecting the domestic price of chocolates.
So in spite of this, do we see deterring demand?
Sorry? I do not get your question.
Do we see this increase in prices? Has it reduced demand?
No, not necessarily, because we're seeing that, like you said, this is the Christmas period and there's an increase in the festive demand for the commodity. And this is not only because of the fact that chocolates are actually suitable gifts for the occasion, but also because of its affordability when compared to other substitute gift items like toys. And also we're seeing that consumers are trading down due to shrinking disposable income and rising prices. We're seeing that instead of completely eliminating their demand for chocolates, we're seeing that they are opting for cheaper or lower priced chocolates rather than the higher priced ones. So this is why we're not necessarily seeing that decline in the demand for chocolates due to the rising price.
All right, Miriam, thank you so much. I guess the best thing would be when Nigeria starts adding value to its cocoa to produce chocolate, and we can even earn some FX from there. Thank you so much for sharing your thoughts with us this afternoon.
Thank you for having me.
All right, now let's just get to the other stories before the program comes to an end. We go to Ghana, where the inflation fell in November to a 19-month low, helped by base effect comparisons with last year and aggressive monetary policy tightening by the central bank. The consumer price index rose 26.4% last month on an annual basis, following a 35.2% gain in October. That's according to government data. Cocoa, gold, and oil-producing country is facing its worst economic crisis in a generation, in talks with bilateral and commercial creditors to restructure its debts. Then we go to South Africa, where the state-owned electricity provider Eskom is anticipated to report its 7th consecutive full-year loss, and that's because of mounting challenges, including a substantial debt burden, high financing costs, poor plant performance, and increasing municipal arrears. And despite posting a profit of 1.62 billion rand for the first half of the fiscal year, the utility faces ongoing financial constraints. Yeah, that country has some relief coming its way. It's reached an agreement to cancel $4.5 billion of its debts with international lenders, raising hopes that the war-torn nation can start to attract investment and access financial markets after decades of economic stagnation. Somalia's debt cancellation under the group of 20 leading economies' debt relief initiative will result in its external debt falling to less than 6% of its gross domestic product by the end of this year. And that's from 42%. So obviously it is worth celebrating. And then in Zimbabwe, the World Bank reports that Zimbabwe needs to spend $4.4 billion on expanding access to electricity if it is to meet its goal of achieving upper middle income status by 2030. Power supply shortages have been costing Southern African nations an estimated 6.1% of its GDP annually, according to the World Bank. So that's the much we can take on Business Incorporated today. Thank you so much for being a part of it. I'll see you tomorrow morning for Business Morning, 10 a.m. So you don't want to miss that, but do enjoy the rest of your day.